And just like that, I made $15 for doing absolutely nothing. Hey, what's up everyone? It's Griffin here. And that scenario we just looked over, pretty cheesy, I'll admit, but that's pretty much what it's like investing in dividend stocks. Once you start investing and continue contributing to your account, dividends just keep on rolling in over time. In fact, this is the reason why dividend investing is one of the most passive income streams that literally anyone can set up with little to no effort, and why dividend investing has become so popular over the past decade or so with everyday investors like you and I. By simply buying shares of a dividend paying stock or an ETF that holds a bunch of these dividend distributing companies all together, while you're jumping onto a passive income conveyor belt, where on a monthly or quarterly basis, you'll start earning that dividend income straight into your investment account. Oh, and not to worry, we're going to be speaking all about what to look for, what to avoid, and how you can go about buying your first dividend paying stock for that passive income in today's video. But let's start with what makes a dividend stock worthy in the first place, since technically any company that pays out a dividend is considered to be a dividend stock. But of course, not all of these companies should be treated equally. Essentially, the question is, how can you determine what will be a good dividend investment and should continue paying you those distributions over time, which ultimately is what you should be after as a passive dividend investor. And if you don't know what to look out for, things can go south pretty quickly. You can think of dividend payments as a way that companies redistribute a portion of their profits back to shareholders of their stock as a way of thanking them for simply holding shares of the company. Because after all, no company is ever obligated to pay out dividend distributions, but some companies have been doing so for many years, and investors have come to expect a dividend payment and an ongoing dividend payment from that company in question, which can become one of the attractive qualities of their stock at all. For example, Coca-Cola is a company famously owned by legendary investor Warren Buffett, where he's owned the stock since 1988 with a current stake worth more than $21 billion. But the point is that Coke has been paying out and raising their dividends annually to shareholders since 1963. That's a ton of dividend consistency, and as an investor, well, you can really start relying on this income source as, yes, both passive, but also like 99% guaranteed. So always make sure to take a peek at a company's dividend consistency and streak when you're doing your research to see if they're fresh on the dividend block or if they're veterans that you can count on to have your back even when times get tough. As a rule of thumb, a streak of minimum 10 years is really starting to get interesting for that consistent dividend passivity, but really the more the better. And you'll also want to make sure that the company is continuing to increase those dividend payments year over year to, at the very least, keep up with inflation. Now, above dividend consistency, you're probably wondering when we're going to be speaking about the dividend yield, right? Which is smack dab right in the middle of a dividend stock's quote and gives us investors a general idea of what type of return you can expect from a dividend stock. Well, kind of. You see, a stock's dividend yield takes its current market price and divides it by the total annual cash dividend distribution that you would receive from that company if you held it for a year. For example, TD Bank currently trades for right around $70.60 per share, and they pay out a cash dividend distribution on an annual basis of $2.83 paid out on a quarterly basis, meaning that total $2.80 is divided in 4, and every 3 months you would get that payment. And when we divide the yearly distribution by the current market price of the stock, well, you get the dividend yield, which in this case is right around 4%. But here's the thing, the dividend yield can actually be kind of deceiving because it doesn't give us investors the full picture. Let me explain. In theory, you'd probably be tempted to just go out and find the stock that pays out the highest dividend yield possible, right? Like Spock Holdings that has a dividend yield above 16%, which sounds freaking awesome, right? I'm already imagining my trip to Cabo, sipping margaritas and collecting dividend checks on the beach. Well, before we get ahead of ourselves with Spock Holdings and their crazy 16% dividend yield, let's compare it to another popular dividend stock being TELUS Communications that trades for right around $25 a share and has a dividend yield of 4%. On the surface, one of these stocks definitely looks more attractive than the other one, right? It has a much lower price point and it has a significantly higher dividend yield. But remember, just because you're interested in potentially generating income from your portfolio, this doesn't mean that you should be avoiding also taking into account capital fluctuation for your total return, right? So the stock's up and down price movements and value over time. All other things being equal, an investment of $1,000 into Spock Holdings would give you around 133 shares versus $1,000 invested into TELUS would give you just around 40 shares. So with $1,000 invested into Spock Holdings, considering that they actually maintain that high dividend yield, you would get around $166 per year in dividend income versus on the flip side, $1,000 invested into TELUS Corporation would give you around $42 per year in dividend income. On the the surface, again, SPOC Holdings does seem like the better option for a dividend position, but let's dig a little bit deeper below the surface to uncover if this is actually the case. So if we take a look at the actual underlying performance of the two stocks in question, well, we can very quickly see why taking into account a full picture here is critical, even if your primary focus is that dividend income. Had you invested $1,000 into TELUS stock 5 years ago, well, that investment would now be worth over $1,500 in the market, and that's not even taking into account any of the dividend distributions that hopefully you would have reinvested right back into buying more shares. Meanwhile, an investment of $1,000 into SPOC Holdings 5 years ago would now be worth right around $422, so significant loss in capital over time. And again, that's not even taking into account any of the dividend distributions, which, as we can see right here, there is very little growth to be seen whatsoever. All of this to say that when it comes to investing and finding good dividend stocks, it really doesn't need to be overly complicated, but there is more to look at than just what initially meets the eye, right? So that you can avoid investing into dividend traps like this, or this. And speaking about stock market research, this actually ties into today's video sponsor, Seeking Alpha. Seeking Alpha is a market research platform that offers users an unparalleled amount of information and analysis on the financial markets, stocks, real estate, exchange-traded funds, and basically anything else you could want from a financial research platform. No matter what index, stock, ETF, crypto, or any other financial security across the globe that you may want information on, Seeking Alpha has a wealth of free tools and information available, which makes due diligence and stock research really straightforward for investors of all skill levels. Now, if you're looking to take your investing one step further though, Seeking Alpha also offers a premium membership giving you full access to every single article published on their platform, along with premium ratings from authors on the platform and their quantitative ratings, which are algorithm formulated using over 100 metrics published daily. For example, here are Seeking Alpha's top rated stock lists, including dividend stocks, growth stocks, value stocks, and other top rated securities lists, which are all premium features by the way, but we can see 3 ratings for this stock being the quant algorithm rating, Seeking Alpha authors, and Wall Street's ratings, giving you a better picture of overall bullish or bearish outlook and whether or not any further research could be in order. Now, based on Seeking Alpha's data, over the past 12 years, their top rated quant picks have actually consistently beat the annual returns of the S&P 500, as we can see from this chart right here. What's more is that the premium membership also unlocks a variety of individual stock data, metrics, factor grades, indicators, and tools, making stock research even more straightforward for everyday investors. So if you're ready to join over 200,000 active premium members on Seeking Alpha, make sure to check out the top link down below in the description, and you can get up to 50% off on your membership, and that's after a 14-day free trial. All right, so thank you to Seeking Alpha for sponsoring that portion of today's video. It's truly through opportunities like these I'm able to continue making videos for all of you to enjoy. Okay, so now that we know all about dividend yield, dividend consistency, and why you should be looking really at the bigger picture here when it comes to assessing the viability of a dividend stock, well, let's speak about how you can go about finding some dividend stocks and exchange traded funds on your own, even though I will be providing some specific companies and industries that you can focus on at the end of the video. Oh, and by the way, just quick side note here, my full stock market investing course, recently just put that over on Skillshare. So if you ever had wanted to check it out, make sure to go over on Skillshare. You can check it out completely for free on a 30-day free trial. I'm just going to put that out there. Okay, so back to dividends. There are many different websites that you can use in order to screen and filter down various different dividend stocks, dividend ETFs, based on the criteria that you're after as an investor. The reality is that there are thousands of different stocks and ETFs that trade on public exchanges. So as an investor, this can be really overwhelming, and utilizing stock screeners is a great tool that as a retail investor, you can narrow down your selection and find quality positions based on really just what you're after. So let's actually click on into Seeking Alpha's ETF screener, and this is what we're presented with. So first and foremost, in the fund focus, we can select different asset classes. So in this case, we're just going to be interested in US equity, meaning these are going to be ETFs that hold American positions. I'm not necessarily interested right now in filtering through municipal bond ETFs, commodities, and so forth. So again, we'll leave it at US equity. Following that, we're going to look at a subclass. So in this case, we can actually filter down based on, different criteria such as large cap growth, large cap value positions, mid cap value, and so forth. In this case, we're just going to leave it at all. From there, we can also select some preset screens. We're not going to be interested in that right now. Now, in this case, based on the values set from the current sliders, there are around 21 results available. So we're going to filter that down in order to see, what we can actually expect. So we have 6 columns, the first one being the ticker in question, followed with the fund name, the frequency of the dividend distribution, so typically either quarterly or monthly. In this case, as we can see, the dividend rate rate. So the dividend rate is actually the cash amount that you would receive for holding a share of that fund over a 1-year period, and then that's translated over into the dividend yield. So in this case, we can see a lot of them are in the 3% range and then move up gradually to the last one in this case, which is the Columbia ETF that has 22% yield. And that's something that I'm right off the bat not going to be interested in, because I know that it's not going to meet what I'm after as a passive long-term investor. So now that it's filtered down though, let me select one of these ETFs so we can do a little bit more research. Let's click on SPHD, which is the Invesco S&P 500 high dividend, low volatility portfolio ETF. Reason why it's catching my eye here, it has a monthly dividend frequency and a yield of 3.32%, which typically over a long period of time is sustainable, especially for an exchange traded fund. So let's click on that one right here, and it brings us to the stock quote, and we can look at some more information in this case. The expense ratio is 0.3%, so with a really passive ETF, this is usually a little bit high, but since it's a dividend ETF, these tend to command slightly higher expense ratios. In this case, 0.3% is nothing all too significant. Now from here, I like to also take a look at just a longer term trend of the chart in question. So taking a look at a 10-year chart, of course, during March of 2020, like everything else in the market, it tanked, but we can see a long-term upwards trend for this position, where over the past 10 years, it is up 86%. All right, and that is not even taking into account the dividend income that you're receiving from that stock along the way. Now, what's also nice about taking a look at specific stocks and ETFs on Seeking Alpha in this case is that there's a lot more information provided to us. So above, analysis, news, and etc., one tab that's really relevant here is the dividend tabs. Let's click on that, and this is going to give us information about the dividends for SPHD. In this case, we have, the dividend yield, of course, the dividend growth rate over the last year. So it is actually down 11%. This is actually not something that is necessarily a huge red flag for an ETF, because, well, in the nature of a dividend ETF, there are hundreds of positions typically that are held within the fund, and as some are raising dividends, others are, maybe pausing them or lowering them over time. That being said, this is why the consecutive years of dividend growth is at 0. And in terms of consecutive years of dividend payments, though, it has continued paying dividend payments for 9 consecutive years. Now, building off of the example from earlier, if you were to invest $1,000 into SPHD, in this case, right, this is just an ETF that we selected at random, but you would get around $33 of dividend income throughout the course of a year, which doesn't really seem like much, but over the course of, decades of investing and compounded growth of reinvestment of those dividends over time, combined with, in this case, the 86% growth rate over the past 10 years, this really compounds into large amounts over a long enough time horizon. That being said, all of this really depends on your strategy and goals as an investor. So if you're looking for strictly that monthly dividend income or just recurring dividend income in general, well, investing in an ETF or a stock that might be trending somewhat sideways instead of appreciating greatly over time could potentially be a good option still, again, depending on what you're after in your investment strategy. So using a stock or ETF screener is really just a great way that you can quickly filter through potentially thousands of positions that trade in the public markets, so you can really just narrow down to the exact positions you're looking for and then selecting a handful that meet your needs. All right, so you might be wondering though, what if I don't want to hold dividend exchange traded funds, right? I'd rather hold individual dividend stocks. Well, that's totally understandable, and for that though, finding viable dividend stocks ultimately comes down to a very similar set of steps. You'll want to make sure that you're first looking at dividend stocks that have a healthy dividend yield. So nothing above, the range of around 6, usually around 3 to 6% is a healthy dividend yield range. From there, you also want to make sure that you're taking a look at the dividend payout ratio. So a dividend payout ratio is essentially looking at the yearly dividend distribution of a company and then dividing that by the net income. So in this case, if a stock is paying out $1 per share per year and they have earnings per share of say $5, well, this would be a dividend payout ratio of 20%. And as a general rule of thumb, looking at dividend payout ratios that are around 50% or less is somewhat of an indication that the company would be able to continue maintaining those dividend payments over time. That is not, set in stone or anything, but if a company has a payout ratio of 90%, this means that they're paying out 90% of their profits out to shareholders in the form of dividends. Dividend stability and dividend increases over time is also something that, of course, we want to look at for an individual stock. So having, again, a dividend streak of around minimum 10 years is usually a long enough streak to be attractive for a long-term passive approach to that dividend position. But, again, the longer the better. Some companies have dividend streaks of over 50 years, and this is basically a surefire way that you can set yourself up for that recurring passive dividend income. Now, above that, also taking a look at the dividend increases year over year. So if a company is not not increasing those dividend payments, this is typically going to have an impact on the yield, but then also not be enough to really keep up with inflation. If a company is increasing their dividend payments by 1% per year, that's great, but again, right now we're looking at inflation around 8%. So again, the larger the better here in a sustainable fashion, but usually, at a minimum 5% up to around 10% per year is something that as dividend investors, you should be looking out for. And upon starting to do some research, you'll probably find this out pretty quickly, but some of the best dividend players are going to be companies that are in industries that are notorious for consistent revenues over time, and also being large industry players that are very established. So industries specifically like utilities, energy companies, real estate investment trusts, telecommunications, consumer staples, and then banking and financials. So that's all I've got for you today. I hope you found plenty of value in today's video. If you did, please take a second to drop a like on the video. It really helps the channel out, and don't forget to subscribe, hit the bell button to be notified of new and upcoming investing and personal finance content. Thanks again to Seeking Alpha for sponsoring today's video. If you want to check that out, use the top link in the description, and don't forget to also take a look at the course over on Skillshare. So with that said, thanks a lot for watching, and I will see you in the next one.